Omar and Angus was, could you do a data drop? Okay, that's quite a broad brief. Hopefully, and judging by the people who put their hands up in the air who do like data, as a daughter of an accountant and working at the London Stock Exchange, probably no surprise to you here that I do like data too. And actually, I think a lot of it, in terms of some of the investment decisions and portfolio allocation, does start with the data. So, I'm really keen that we do delve into that. I do a little bit of a reality check of where we are today, and then share with you some of the findings that have come out of a report that we did at London Stock Exchange, the Net Zero Atlas. Because I think it will hopefully also just lead nicely into the session that we've got coming up on transition finance and impact as well. Hopefully you can see some of the slides and a graph, but look, I think we all know, as climate extremes become more frequent and more severe, physical climate risk really is accelerating and becoming systemic as well. And no single extreme weather event can be attributed to climate change. However, a lot of the climate global models consistently demonstrate that these extremes are not outliers at all, but actually they reflect that ongoing broader transformation that we're seeing in the markets. And what remains less clear though is where and to what sort of scale some of these physical climate risks will actually materialise. Also, I should point out, there will obviously be a lot of numbers and data I'll share, but there isn't a test at the end of this. But hopefully some of the numbers and the data will resonate and stay with you and lead into the conversation that we're going to have. So the London Stock Exchange Net Zero Atlas that we did for COP30 was an analysis of about over 4,400 regions in 8 G20 countries, which showed that climate hazards are projected to intensify significantly. And the regions that were analysed covered over about 2 million different people and generating about 60% of global GDP. And some of the findings that were in there was that by 2050, over 800 million people and $28 trillion US in GDP will be exposed to high physical climate risk. So they're big numbers. I should say I'm trying to be positive with the data here as well, and it's not supposed to be dry or data that actually sort of leads us into any doom or gloom, but actually I think it does give this reality check piece and hopefully sort of leads us into some of these action and change that we want to generate. And some of the key hazard trends that came out were around heat waves, with surging from under 10 million to over 327 million people that's going to face extreme heat. And that's coming from areas like LA, Houston, Shanghai, Hong Kong. And then you've got the water stress as well, and wildfires and cyclone risks intensifying. And then from a flooding perspective, you're seeing how GDP exposure is going to triple, with UK being one of the most sort of exposed areas as well. Now, I'm not sure that everybody at the back can see this, but it's hopefully visually you can see some of the heat maps there. And it shows those hazards on the map. And I think so ultimately the LSEC research team believe that the conditions that are described are broadly representative of some of the medium-term physical risk landscape that investors are going to face if we're looking at the emissions reduction efforts, and then if they're not substantially accelerated to help to achieve net zero emissions by the middle of the century. So it's showing really sort of this analysis shows the rapid economic growth and limited mitigation efforts means that the goals of the Paris alignment are not really being achieved. But what we're seeing is that transition finance, I think, has entered a bit of a new phase. And I'm sure we're going to discuss this a lot more in the panels to come. And the focus has shifted from commitment to action. But actually, some of the actions to date haven't yet aligned with the commitments that we're seeing. So investors are increasingly requiring deeper assessments of how companies are implementing their transition plans, coupled with the evidence of the actual effectiveness of those transition plans. It's not just about sort of the the data, the implementation is actually how effective are they? And in 2025, the TPI State of Transition report assesses the credibility of corporate transition planning so that it can have a clearer view of that reliability of companies' delivery against the transition ambitions and targets that they're setting. And I think, those forward plans really are mattering and targets are mattering because investors increasingly want to know the credibility of those plans, how effective they're being, and actually what are those real-world outcomes? What have the companies done to deliver a transition? But beyond the pledge, I think assessing that credibility becomes very complex. And if you look at some of the work that TPI have done, and they've conducted 3 different complementary analyses to provide insight on that issue. You've got the management quality level 3, that are management and governance indicators that specifically evaluate companies' transition plans and implementation. And almost all of the 2,000 companies assessed are showing some clear gaps in that planning and implementation. And you've got, historical emissions intensifying trends are really sort of being used to shift from analysing future ambition to examining whether companies' recent emissions intensities have been falling in line with how have been set the Paris Agreement goals. So I think taking together all of the different analysis there, they really show that the net zero emissions are rarely supported by convincing transition planning and implementation, and they require emissions reductions beyond those that companies have actually recently been achieving. And in some cases, you've still got unproven technologies as well, and that very much sort of can have some dependencies on that. Going back to some more charts for you here, and looking at sort of this corporate alignment. I think also in the TPI report, they assess the carbon performance of over 500 different companies in 12 high-emitting sectors, and it really sort of showed that in the long term, 43% of companies are aligned with either below 2% or 1.5%. However, in the medium or short term, only 34% of assessed companies are aligned with either below 2% or 1.5%. So I think this is implying that companies are backloading some of the decarbonisation efforts into the future. But what also we just want to look at is how we've seen sort of the investment case for clean energy evolve. 5 years ago, it was very much framed around climate risk and decarbonisation. But today, I think the rationale has really broadened significantly. So you've got capital being deployed to reduce emissions, but it's also strengthening energy security. It's improving industrial competitiveness. It's also building the resilience in supply chains and also reducing some of that exposure to geopolitical volatility. And in the latest IEA report, we can expect to see global energy investment reaching around 3.4 trillion this year, with growth really coming in areas that are concentrating around sort of electricity and grids and storage, electrification and efficiency, and fossil fuel investment has been relatively sort of flatter within that. So the gap, where is that transition finance gap, and how do we look to fill it? I'll try and give some insights into the transition finance gap. I think perhaps the panels are going to address sort of how to do that, how to fill it. I think we've seen a lot of success. I don't think we should take that away from ourselves in sustainable finance in the past decade. You've seen climate finance flows now reaching about $1.9 trillion annually, which is a major achievement. But we all know that the investment required is far greater than that. And so we have got that funding gap at the moment. And if we look at sort of things like what's been happening in the sustainable bond issuance market, in 2025 it reached about $980 billion, down slightly sort of year on year, with green bonds being sort of the majority of that component, compared to transition bonds, which frankly are probably a bit more invisible in comparison for that, and count for about 1% or less than 1% of sustainable bond issuance. So So I think the kind of I'm taking from this is the message isn't that that sustainability hasn't failed, but it's grown substantially, but the issue is that there is still a need for much better financing of some of the complex and the capital-intensive industries and high-emitting businesses, rather than sort of the already green activities. So, and I think this shows this, that capital goes into often to sectors that are already green, and they are more complex areas for investors, with longer time horizons when you're looking at some of the high-emitting sectors, more policy, technology uncertainty, and a greater need for those credible transition plans that we were talking about earlier. So I think that's why capital has been a lot slower to move into those areas. But I think the limited scale of some of the transition finance, you can see how that's reflected geographically as well. As you can see the chart and the names on the bottom and the countries at the bottom. But what does stand out for me in there is Japan. And whilst transition bond issuance remains concentrated in a number of the smaller markets, Japan stands out, averaging I think it's about 60 to 70% of the global issuer market. And I think a lot of that is dependent on the fact that they've got a very clear national strategy around transition finance as well. So a takeaway from that for me is what lessons can we learn from there as well. And then look, a little bit on the market infrastructure. I think some of the barriers around access to transition finance has been around credibility. And investors want to support some of the decarbonisation in high-emitting sectors, but there's been often sort of less consensus and understanding around what actually constitutes credible transition activity. So I think that a lot of that, though, we've seen developing over in recent years, some of those foundations for it. You've got standards like climate transition bond guidelines. You've got all the work that's come out of the Transition Finance Council with guidance supporting credible transition plans. You've got growing regulatory disclosure and expectations. So I think it's all moving in the right direction. Does it mean that we're going to have an immediate explosion of a transition bond issuance? I'm not sure that's what the forecasts are really telling us. I think you're just going to see most volumes still coming from the green bond market. I think some predictions around sort of 40 billion this year. But I think having more production of transition finance frameworks is helpful in future guidance of where the transition finance allocation can come from. And I just really wanted to sort of touch a little bit on impact, because I think that's also going to be covered in the next session as well, because I think often we've seen impact investors avoiding those high emitting sectors, but actually many investors now recognising that the largest emissions reduction will actually come from that transformation of those incumbent industries. So you've got that coupled with the focus on sort of broadening from mitigation into resilience as key sort of factors that are accelerating some of the trends in the market. So I think the emerging view is sort of seeing around impact investing providing sort of the why, the outcome piece, and transition finance providing the how, as in capital and transition pathways. So I think together they can really accelerate this resilience transition to a low carbon economy. And I think for me, together is that really key word. I know it's not a data word, but it's a key word. Together is key here, because if we've got the data and we have the knowledge and we're actually turning this into action and policy and financing opportunities, it is about how we do all of this together. I'll pause there and hand back to Sarah for the next session.